Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Welcome back, Mike.
Thanks for having me back.
Yeah,
Hello, Evan.
it's such a huge pleasure having you back. You were on about a month ago and we were talking about the economic outlook and what's happening with precious metals. But everyone in Wall Street Silver is keeping their eye on silver and gold right now really
Yeah.
closely. What do you see the outlook for your short-term or long-term outlook? What's your view right now, Mike?
Bullish gold, bearish everything else, and that includes silver and copper, industrial metals. I just published my latest silver update. And the problem with silver is it's down 5 to 6% this year, along with industrial metals on average that are down about 20%, the Bloomberg Industrial Metals Index, and gold's up about 9 to 10%.
Right.
Those to me are bodies in motion that I think are at greater risk of accelerating next year, particularly, I should say more when the U.S. enters a recession. Obviously, it didn't happen this year. A lot of us were wrong in that, but the tilt is increasingly that way from a macroeconomic industrial demand standpoint. Europe's already in recession. It was just a few months ago they were hiking rates. GDP is negative, and retail sales are negative, and PMIs are negative.
Right.
China is very quickly tilting that way. Every time I type in the Bloomberg terminal anything to do with China, property crisis I hear is there's hopium, but it's just getting started. Just like Japan did, and a lot of people tell me it's a lot worse than the U.S. was when it peaked in 2005 and 6. And then there's that U.S. bent. So to me, there's an inordinate need for the U.S. stock market to stay resilient in the face of a recession, in the face of the normal effects from Fed hiking, which means that that's to me the biggest tilt for next year is these trends in commodities accelerate, and that favors gold versus everything else.
And a lot of people are also keeping their eye on, Jerome Powell and what they're doing at the Federal
Yeah.
Reserve. What do you think's happening next, Mike? What's the most likely outcome? Do you think they'll do a pause, a raise, slow down their rate hikes? What do you think will happen?
Well, it's officially paused already. Now, I see virtually no need or incentive for the Fed to even consider cutting rates until we have some negative wealth effect to reverse the major inflation that massive liquidity provided with COVID. That to me is going to be the lessons of history. So when they go to make that decision to push that button to start adding liquidity to the system, they have to be quite certain they're not going to have to take that back right away because of inflation they helped create it. And to me, that's what's going to resonate. That's what's different from every single time they've eased in the past. So here's one little fact. Typically, when the S&P 500 is down 20% on a 12-month basis, since 1960, the Fed has cut rates.
Right.
When it's up 20% on a 12-month basis, they usually hike rates. It's up 20% on a 12-month basis. And their metrics for inflation, PCE, employment cost index, CPI core are all well above 2% targets. Yes, they're dropping, but they're closer to 4%. So I look at it as why take the risk? Until the whites of the eyes and basically the stock market going down, there's no reason the Fed should ease. And yet the market's price for right now, as we tape this before we get the news from the Fed, is as of the May 1st meeting, the market's fully priced for 125 basis point cut. And I think that's just silly.
Right.
The market, and it's going to take a catalyst. And I think the catalyst for that to happen would be the U.S. stock market going down, because I look at it from a risk reward standpoint is why bother? Everything's great. Why mess with it?
Yeah, that's true. Do you think they're waiting for something else, like maybe more on the jobs report side, like maybe massive job losses compared to the
Yeah.
stock market? Yeah, is that something they're looking at?
Yeah, so the latest report that printed in December for November is obviously quite strong, but it didn't change the base case from our Bloomberg economics team that we're clearly tilting towards recession. Now, we have many other metrics pointing that way. One is, I like to point out, we have recessionary declining demand in diesel, in unleaded gas, in natural gas, and container boards. So those are some things that I'm very close to. And then we have things like the inverted yield curve, and just a simple fact, it was only a few months ago, most central banks were still hiking rates. Those effects, full effects, are not even close. So one thing they're watching real closely is retail sales, how retail sales will do this period. It was when retail sales came out in the end of 2007, that was one of those signals that the Fed should start cutting rates, and they had already start cutting rates. So by the time this airs, we might know, but
Right.
that's just, there's still all so much little data and minor data. The macro is, yes, I've been early, but if you look from the market, if you look at the indicators from the commodity markets, it's clearly recessionary. Gold's up, and the Bloomberg Energy Index is down about 20%. The Bloomberg Industrial Metals Index is down about 20%, and
Right.
the Bloomberg Grains Indexes are down about 20%. So this is a clear global deflationary, recessionary trajectories. And the quick question I have to ask myself is, what are we doing to arrest those? And central banks I even start. Typically, you need a lag to the first Fed rate cut. Usually, it's about a year or two before things bottom. China is trying to stimulate, and the U.S. is just on the back end of massive fiscal stimulus that we
Right.
cannot continue because we ballooned the deficit so much.
So I just wanted to let everyone know about our new sponsor, Strategic Wealth Preservation. They are an international precious metals dealer, and they are a secured storage provider that have headquarters in the Cayman Islands. The company owns and operates a large Class 3 UL rated vault in the Grand Caymans, and they offer other strategic locations as part of its global storage network. They specialize in the acquisition, secure storage, and liquidation of precious metals for individuals, companies, trusts, and wealth management professionals on behalf of their clients. So if you guys want to check them out, the link is in the description below. I actually seen something yesterday that was mentioned again by some people online about the interest on that actual debt of the 32 trillion. It's soon going to be the upward of a trillion a year. And how unsustainable is that, Mike? Having that just the interest alone on the debt servicing for that.
Well, gold making new highs in the Dow and virtually every other currency, I think answers that question. I don't know
Right.
what stops it. I think at some point maybe some austerity will kick in, but that definitely doesn't help get elected.
Hmm.
And as we tilt towards an election seasons typically are not very good for consumer sentiment. So the tilt is quite negative for that to continue, and for things that do well in that environment, like gold and Bitcoin, to continue and potentially accelerate. So that's why I look at next year as, I would be delighted if there was a good reason for gold not to just blast off and head towards 3,000. Those good
Wow.
two reasons are a resilient U.S. stock market and high U.S. interest rates, which means a strong economy and everything, which to me would be a dream. That's why I look at gold right now as it's a put option on the U.S. stock market. Silver is more correlated with the stock market if it goes down. That's why industrial metals are. That's why
Right.
this year is a bit of a divergence. I think, to me, gold's looking ahead to what you just said is probably not getting better. That just the normal revisionary lower tendencies of elevated equities and elevated interest rates when you head towards a recession.
Hmm.
And it'd be wonderful if this time next year we're not talking about severe deflationary forces, and we're not
Yeah.
talking about gold heading towards 3,000. But I think those are just the trends that are your friends, and I don't see what stops them until you get to a long and lag to Federal Reserve easing. And this is how the world's changed. Here's one thing that's a fact. Like, as of today, we just printed the PPI year over year material goods number. It's down 0.9%. Now that's PPI. It's a two beta. It's a good. It's like just high. It's a two beta to CPI. And it's like very closely
Right.
correlated to commodities. And Fed funds upper bound is 5.5%. Yet they can't cut because most of their metrics are still very high. So I have to say that that wide crocodile jaw disparity in some inflation metrics already deflating, commodities already deflating, and Fed funds still high, are just trickling down. And the key trigger will be U.S. stock market just having a normal correction, and
Right.
that's why it's an inordinate burden for the stock market to stay up, which to me means that's your risk reward.
Absolutely. And Mike, it's such a pleasure having you come down. Before you head off, you were mentioning container boards earlier. That's what you were looking at closely. What's the significance of that to the economy? And you said you were looking at that. What does that mean?
Well, I remember watching container boards. Corrugated boxes when I was trading treasuries in the trading pits in Chicago in the 80s. It was just a
Hmm.
good leading indicator, not so much leading indicator of demand pull from consumers. Now, much more than ever, because who doesn't push a button and get a package arriving on
Yeah,
Amazon? I mean,
everyone.
it's just everybody, everything. And the fact that that demand is declining at the same velocity as it did in 2008 and 9, right before the great financial crisis, or right during the great financial crisis, I think is very disconcerting. Yes, maybe we've turned to more of a service economy, but it's indicative of why PMIs globally are negative. And why trucking is negative, why diesel demand is negative, all those things that used to matter for global for the economy are, for me, are just severely negative.
Right.
And there's some things that are kicking off. Unemployment's still good, but this is part of the distortions of what we did with the pandemic. And it's trying to put rationality on these things, and that's why I look at it as every time I look at commodities and write about silver and anything that's industrial sensitive, I have to say, well, gosh, if that stock market just keeps going up, well, they might stay. Then these commodities might stay stable. But if the
Right.
stock market just, would say, reverts 50% of this year's gain, that's a trickle down deflationary recession or domino trajectory. And the question is, what's the Fed going to do
What
about it?
happened in 2020 when like COVID hit? You seen a bunch of like the stock market, of course, went down, and then you seen silver, it went down to like 13, $14
Yeah,
for a second there. So if it
yeah.
happens again, it's not it's not it's normal if it happens again. But Mike, it's such a huge pleasure having you on. Where can people contact you? Where can people find you and connect with you?
Well, thank you for having me. I mean, it's my
Yeah.
pleasure. I'm available on Twitter at Mike McGlone 11 and on LinkedIn, Mike McGlone at Bloomberg. And if just shoot me a message, and I'm happy to add people to my distribution list.
Awesome. Well, it's such a huge pleasure, Mike, and hopefully we can have you back on in the future to Wall Street Silver.
Looking forward to it, Ivan.
All
Thank you.
right. Talk to you soon.